Welcome back. Let's bring in our guest host for this hour, Tony Nash, Global Director, Custom Research, Economist Intelligence Unit. And in New York, joining us is Matthew Grossman, who is Chief Equity Market Strategist at Adamesh Trading Group. Let me start with you first of all, Tony. You say Saudi Arabia, the world's largest exporter, is stable. Why?
Well, in terms of the oil supply issues, many of the installations are in very remote areas. So Saudi is a stable government. There are some there have been for the last 10, 15 years a lot of issues in terms of raising Al-Qaeda and other protests within Saudi Arabia, but much of that has been under control.
So if there was unrest, if we were to see it, would be concentrated in the major cities, and this wouldn't affect the oil output.
That's right, that's right.
Which is kind of a relief. Let's get Matthew in here. Matthew, what do you make of that argument?
Well, it's nice to hear and it's nice to know that, but I really do believe from a trader's standpoint like myself, this isn't a supply issue. We're not having an issue in supply of oil across the world because of what's going on in the Middle East. It's a fear issue. You know, we've seen WTI, we've seen Brent rally about 20%, and so my fear is that, and that's Libya. Libya is only the 15th largest oil producer in the world. Saudi Arabia is #1. So I can only imagine what would happen if we actually see protesting, let alone turmoil, go on there, whether or not supply was affected.
Fear issue, sir. Matt, are you saying this is a speculator issue?
I'm saying that it's hard not to just look at it face to face and say, okay, oil, WTI crude went from $85 to $100 in 2 trading days last week. We had a 3-day holiday here in the United States, and on Tuesday and Wednesday. And we didn't see a very big disruption in supply in oil. We actually didn't see any disruption in supply in oil over those days. But we moved up 20% in the span of 2 trading days. And that's for the 15th largest producer of oil in the world. So for me, I look, the supply is a very big issue. Don't get me wrong. It's not something I don't pay attention to. But I think, at least in the short term, it's about fear. And I think that's what everybody needs to pay attention to.
You know, Matthew, I tend to concur, just from my humble viewpoint up here in Hong Kong. I mean, prices have been spiking up at the pump. We've seen this before, and you're saying it's a fear factor issue. It sounds like somebody is messing with our minds, and the smart money would be putting stop losses in and maybe shorting this, because once we hit the big magic number, say 120 or north of that, it's going to come tumbling down when everybody pulls out.
It's definitely a possibility. I think what people are seeing right now is that, again, if you take a look at the history of how oil's traded for the past month, we saw unrest in Egypt, oil spiked from 85 to 94, and then it fell off. And everybody said, okay, it was just going to be contained to Egypt. And then everybody was kind of caught snoozing, and 2 weeks later, we saw this big jump from 85 all the way to 100 based on Libya. And now I think there's such fear in the market that a next country could actually happen. We're not going to see a very big pull-off, or excuse me, pull down in the price of oil within the very near term. I just don't think that's probable.
Why hasn't the market picked up on that then? I mean, Gaddafi is, vowing to fight to the last drop of his blood. And yet, even the opposition knows that it's stupid to cut off the spigot. And, oil exports from opposition-held cities in Libya have resumed. Everybody needs money. It's not it's not good versus evil. Everybody needs funding. Why hasn't the market picked up on that theme at all?
Well, I think it's a 2-part answer to your question. The first is that the people who are protesting, the people who are revolting, they need money, but they're arguably living on $2 or $10 a day, so they're not thinking about, oh, well, we need the spigots turned on for oil. That's not what they're going for right now. As for the markets have been amazingly resilient, incredibly resilient. In February, while this was all going on, the S&P 500 was up 3%. In January and February, the S&P 500 was up 5%. A lot of people have been calling for a pullback, and it just has not come. World markets-wise, I mean, we see a 11.6% drop in Saudi Arabia in their markets over the past 3 days. So other markets have been feeling it more than the United States. Maybe it's a delayed reaction. I got to tell you guys, I mean, if we see another price spike in oil, you will see the markets come off.
Okay, Tony, come in on this. I see you frowning here.
Yeah, Thanks, Matthew. You talk about the threat of the next kind of domino falling. What do you see as the next plausible threat? Do you really see Saudi as being the next plausible threat? I guess the other question I have for you is, this seems to be the reemergence of the realization of political risk among investors and investment banks. I know that in the recession, a lot of those political risk analysts were laid off. So are investors now re-waking up to political risk? Is that something that that they weren't paying attention to and now they are paying attention to over that 2-year or 2-day period when oil prices started to spike?
Yeah, well, here's what's going on in Saudi Arabia. I think they're doing a very good job managing the situation over there. I mean, just yesterday, it's today for me, it's yesterday for you guys, they started handing out $37 billion in social benefits to their people to fight the massive inflation that they're seeing, as well as the more than 10% unemployment. So at this point, I believe that they're doing a pretty good job of managing any type of possibilities that could arise in an eruption of protesting. But at the same time, when people really ask me, it's a question of politics in the Middle East, not so much about the economy. So it's a hard thing to predict, at least on the short term. But thumbs up to the Saudi Arabians for handling it the way they are now. As for political risk, I mean, there's no question about it. Now, that's just everybody's attention is now focused on what could be the next thing across the world that could set off some type of negative response to the commodity markets or the equity markets. I think that's that's under the spotlight again, no question about it.
Matthew, thanks for staying back late to join us. Appreciate it very much. We'll talk soon. Matthew Grossman,
Thank you, guys.
in New York. As we head to break, here's our Squawk Stack question of the week. If oil stays north of 100 a barrel, will it choke off the global economic recovery? Vote yes or no on asia.cnbc.com. Back with more Squawk in 2.
CNBC, first in business worldwide.
Well, we do have crossing for you now. Q4 GDP numbers out of Australia. They've come in line with expectations. We've got Q4 GDP up by 0.7% quarter on quarter, which was broadly in line with consensus. A Reuters poll was looking for 0.6%. Over the year, 2.7% is the number. Reuters was looking for 2.7%, but my consensus forecast had 2.8%, so slightly missing there. Final consumption expenditure up by 0.6%. We saw fixed capital expenditure down by 0.2%. We've also had a revision to the third quarter growth there now, just up by a fraction, 0.1%. The previous reading was 0.2%. So particularly slow growth in the third quarter, but the fourth quarter numbers are the ones hitting today, 0.7%. Of course, this is the first quarter that we are starting to see some impact from the floods that did, of course, grip parts of Queensland during the months of December, spilling in to January, but it doesn't appear as though they've had much of an impact as yet. 2.7% is the number year on year. Let's look at the Aussie dollar reaction. Not much. 101.42 is where we were sitting ahead of these numbers being released. In terms of the Australian equity market reaction, pretty much unchanged as well. We're down by 0.7%. We were lower by about that amount. We're down by 34 points, 4,792. Let's get back to our guest host now in Singapore for some reaction to these numbers. Tony, broadly in line with expectations, but we did have a revision in that third quarter. What's your outlook for Australian growth moving into the 2011 calendar year?
Sure. I think the big relief in the Q4 numbers is that there was limited impact from the floods in Queensland. So as that kind of supply shock has got over and that natural disaster has got over, I think much of the outlook is focused on commodities and the commodity markets. So you mentioned the investment numbers. So we'll look to see potentially some additional investment in the commodity sectors to bring about more efficiency in commodities for those exports.
Okay, thanks very much for that. So we will, of course, just repeat those numbers for you. 2.7% was the year-on-year number, 0.7% quarter-on-quarter, which is in line with expectations. Let's get a market update now on Tokyo with Kauri and Joji.
Thanks a lot, Matt. The market's down 1.7%, 10,572. But a lot of discussion about Yahoo and SoftBank this morning on this Reuters story that SoftBank and Yahoo are in discussions whereby SoftBank would buy out Yahoo's stake in the Yahoo Japan venture. Yahoo shares are now up more than 5%. Conversely, SoftBank shares are down 3.9%. Same article says the stocks are ongoing and it's not a done deal so far, and I think it's going to complicate things because Yahoo has been making wants to make a big push in China and has been talking to Alibaba, but SoftBank is also in a partnership with Alibaba. I remember 10 years ago, Masayoshi Son, the head of SoftBank, was raving about Alibaba when no one had ever even heard about him. So he was one of the pioneers in this space, so that could complicate it. So they're involved in this sort of triangular relationship in the internet space in China, Japan, and the U.S. So that story bears watching as well. Auto stocks lower across the board despite very strong sales out of the February U.S. market, best in 18 months. It's oil that's complicating things. We're looking at levels that we haven't seen since 2008, and remember how the U.S. consumer reacted. But things are different this year because a lot of players it's not just Toyota with their Prius, a lot of players, diverse players coming out with hybrids and pure electric cars. And of course, the buzz is in Geneva right now where the motor show has just opened. And everyone likes to see a nice-looking car. So let's show the electric car that Nissan has unveiled. It's a prototype. It's a sports car. There you see it, the S-Flow, banking on this zero-emission technology that they rolled out last year with the Leaf. But the problem has been they're really only the only player with a mass-market electric car. So kudos to Carlos Ghosn on that front. And it's interesting that Carlos Ghosn, I think when he was touting the Leaf and out there marketing it, made a very interesting analogy, which I'll never forget. And he said, people can talk about hybrids, people can talk about electric cars and compare them. But to me, the bottom line is, if you smoke one cigarette or if you smoke one pack a day, it doesn't matter, you still smoke. So he's the all pure electric guy. And there are lots of others at the Geneva Motor Show, the plug-ins from Volvos, the Premiers, and also the Rolls-Royce machine coming out with a version, a test version as well. Kehoe in Seoul, over to you.
Thanks a lot, Carrie. Traders in Seoul are starting to react to South Korean automakers' February performance in the U.S. market right now. Shares of Hyundai Motor is now in the green, up by about 0.3%. The auto parts manufacturer Hyundai Mobis is up 3%, while Kia Motors is up by close to 1.5% right now. Figures show Hyundai sold more than 43,000 units in the U.S. last month, which is up 28% year-on-year, while Kia sold more than 32,000, up 36% from a year ago. Now, the combined market share, meanwhile, jumped to 7.7%, adding to positive outlooks that we're getting this morning, that the momentum for the South Korean car makers will continue. Hyundai's new Elantra model and Kia's Sorento SUV were chosen as the car of the year by the Consumer Report earlier this week. Their new cars, the Elantra and Kia's K5, are set to hit the U.S. market this month, are expected to continue the new car effect. So a lot of attention on that as well. Elsewhere, construction stocks are continuing their fall right now. Hyundai Engineering and Construction is still off by close to 3%, pressured by the worsening situation in Libya. But generally, we're seeing stocks recovering earlier losses. The Kospi is now trading about 0.25% lower at 1934. Martin, back over to you now.
Okay, thanks a lot, Kehoe Kim. They're live up in Seoul, SBS, CNBC. Emerging market powerhouses, China, India, showing themselves to be growth dynamos for the coming Asian century. China has just revised its growth rate lower to 7%. New Delhi sees growth powering ahead at 9%. But as runaway inflation threatens to slow down consumption, which of these economies has the edge? Let's talk to Vishnu Varathan, Asia economist, Capital Economics Asia. Our guest host is still with us, Tony Nash, Global Director, Custom Research at the Economist Intelligence Unit. Vish, good to see you again. Welcome back.
Good to be here.
So who do you think has the edge in terms of, controlling inflation?
At the risk of oversimplifying, I think China has got the edge. And there are primary reasons for this. India is structurally more prone to inflation. They don't have, they don't have the kind of infrastructure that China has. So in terms of storage and all, they are more prone to supply shocks. So that's one. The other reason is and I think this is an overwhelming reason, China has a greater capacity to coordinate policy. So despite India's best intentions and the fact that at face value it looks like they are going to tighten fiscal policy further, reality is that they will not be able to do so without a struggle. It's going to be a huge struggle.
Okay.
I mean, if we looked at last year's fiscal deficit, it narrowed. I think their estimate is 5.1. Market is even more optimistic. They think it may be below 5. But the reality is that if you